Risk comes from investing all your money in one style. Market trends can change quickly. For example, investing all your money in high quality stocks were popular in 2018-19, or momentum style of investing dominated in 2021. If you only invest in one style or in one asset like say equity, you risk losing money or missing out on the gains. The best time to invest is when the fear is high and valuations are low. And the worst time to invest in equity is when greed is high and valuation is very high. This is very simple, but it's very difficult to practice due to emotion. Our brains are wired to do the opposite. Shankar and Narayan suggested using a valuation-based band to assess market conditions. Red zone represents an expensive valuation zone. It shows greed or euphoria in people. The red zone is characterized by extreme confidence amongst investors, a surge in new investors, lot of demat accounts being opened, and an increased interest in multi-bagger stocks. During this time, investors may consider moving some funds out of equity, invest them in fixed incomes such as bonds and commodities or gold. And green zone indicates excess fear in the market. This happens when a big negative global event occurs, such as Lehman failure, WTC bombing, COVID, or the Asian financial crisis. During such market crashes, investors may consider moving their money from gold and debt funds into equity funds, taking advantage of the green zone and the opportunity to invest in cheap valuations. These movements from one zone to another and the switching of funds may happen once in many years. Every decade or so, there is one big opportunity that is characterized by cheap valuation. Equity in your portfolio plays the role of a wealth creator, but also goes through phases of consolidation and growth. Bonds and fixed income aims to offer stability to your portfolio and provides opportunities for consistent return over a longer time horizon. Gold also comes with its phases of consolidation and growth. It acts as a good hedge, protecting your portfolio against inflation and global risks. Allocation to these assets at an appropriate time looks simple, but is counterintuitive. This is explained by psychologist Daniel Kahneman with his thinking system 1 and 2. If you ask what this represents, it'll take you a few seconds to respond. But if I ask you what is 41 into 65, then it might take a longer time. Our brain has two ways of thinking, system 1 and 2. System 1 thinking is intuitive, fast, and subconscious. But this system can lead to biases and errors. System 2 thinking, on the other hand, is slower, more conscious. It evaluates the pros and cons of a decision. This system can help make more rational decisions by overcoming biases. But it can be time-consuming and mentally very taxing. When it comes to investing, solely relying on system 1 thinking can lead to misadventures, such as investing at the peak of a bull market or not investing during market panics. It's important to take time to research and analyze important information before making an investment decision by using system 2 thinking. Look at the football example. Despite statistical research indicating that there's an equal chance of a football hitting the center during a penalty shootout, the goalkeeper tends to jump either to the left or to the right. The probability of the goalkeeper remaining stationary without any movement is very low, even though the likelihood of the ball coming to them is much higher. There are some situations where system 2 looks logical to be used, but due to mental shortcuts, we tend to apply system 1 thinking. This is called heuristics or mental shortcut. We confuse activity with productivity. Investors who crave to be invested in the best funds will have to churn funds frequently to satisfy their craving. This will incur taxes and diversify the portfolio to a point where it looks like an expensive index fund. If you like this video, I would request you to please like it and subscribe to my channel. Please do consider sharing it with your friends. Thank you.